Managers are responsible to make a variety of decision-making. This week, we'll discuss the use of relevant costing to assist managers in making non-routine operational decisions, also known as tactical decision-making. There are 4 objectives from learning this topic. First, to understand the non-routine decision-making process and related to various cost concepts that we've learned. Second, to know the difference between relevant and irrelevant information and how to use them in decision making. Third, to identify alternative options in operational non-routine decision making and undertake quantitative analysis for this option. And the fourth one is to describe the qualitative factors that are important to non-routine operational decision making. What do we mean by non-routine decision? So non-routine here means they are not happening on a regular basis. This type of decision arises when we evaluate current process and we want to improve processes, or because we have limited resources or capacity, or perhaps at some point a customer wants special treatment on their order. We will look at 6 different types of non-routine decision. First, whether to accept or reject a special order. 2, to insource or outsource. In a manufacturing company, many people usually call this type as make or buy decision. Third one is to manage capacity constraint and product mix. Fourth is to keep or drop parts of business. Can be business segments, product line, or customer groups. 5, to sell a product or process it further. The 6th one is whether we need to replace an equipment or keep using it. If we look at operational decision making, the first step for you is to identify the type of decision that you must make and identify the 2 alternatives you have. For instance, whether it is a special order type decision or whether it is a make or buy decision. You need then to perform quantitative analysis, which means, you need to identify how the current statement of profit or loss will change as a consequence of the decision faced by management. So the technique will be an option of whether you will need to do relevant cost analysis, whether you need to do CVP analysis or regression. In doing quantitative analysis, first you need to identify the input variables, identify which input variables that are known and which ones are unknown, and then estimate the unknown input variables, apply the general rule for decision making, interpret the result, and then consider the quality of information itself. Equally important is consideration of qualitative factors relating to the decision alternatives you have. For example, in a special order decision, you need to consider what will be the impact on your current or existing customers. And in an outsourcing decision, make or buy decision, the analysis must consider the ability of the potential suppliers to meet the quality standard and delivery timelines that you expect. Depending on the circumstances, the qualitative factors that you include in your analysis can override any positive financial outcomes from quantitative analysis on the decision. To make decision, you need to consider both quantitative and qualitative factors. Depending on the circumstances, the qualitative factors that you include in your analysis may override any positive financial outcomes from the decision. Most of these non-routine operational decisions require the use of relevant information. So what are the criteria for relevant information? 2 main criteria. First, it occurs in the future. 2, it will be different between alternatives. Therefore, cost or revenue will be relevant if it happen in the future, and it will be different between the alternatives you have. Any cost that is avoidable and can be eliminated by choosing one alternative over another is also relevant. It is irrelevant if it is historical costs. Cost that has already been incurred and cannot be recovered is called a sunk cost. A sunk cost is irrelevant in tactical decision making. Future costs or revenue that do not differ between alternatives are also irrelevant in your analysis for decision making. The analysis techniques that we will use in this topic is called differential analysis. Sometimes it is also called incremental analysis. It is a management accounting technique in which we examine only the changes in revenues, costs, and profits that result from a business decision instead of creating complete income statement for each alternative. Differential analysis focus on relevant costs and revenue associated with a particular business decision alternative. Here are some cost terms that we will use. The additional total cost incurred for an activity, we call it incremental cost. The difference in total cost between two alternatives, we call it differential cost. If we focus on revenue, the additional total revenue from an activity, we call it incremental revenue. If we compare the difference in total revenue between two alternatives, we refer it as differential revenue. In addition to this, another concept that is important is opportunity cost. Opportunity cost is the benefit foregone through the acceptance of one decision over another. If we put this concept in a business situation, opportunity cost is the profit loss when one alternative is selected over another. An example of opportunity cost is holding costs for inventory. The inventory holding costs refer to those costs associated with storing inventory that remains unsold. It typically includes warehousing costs such as rental costs if you rent the warehouse, utilities, salaries, and also insurance. It may also include the price of goods damaged or spoiled. This money could have been invested in a bank, for instance. Then the return that you could have received is the opportunity cost for you. Now let's have a look at the different type of tactical decision making. The first one is a special order. It occurs when an existing or new customer places a one-off request for a product or services, which may or may not be a part of your normal business operation. Managers have two alternatives here, whether to accept or reject a customer's special order. The characteristic of special order may include reduced price, discounted price compared to the normal price that you sell to your regular customers, personalization, non-standard order size, or special delivery characteristic. The general rule for special orders is that we want to be as well off after accepting the order as before accepting it. To consider a special order, first we need to know whether we have enough or spare resources to fulfill the special order. If there is spare capacity or idle capacity, minimum acceptable price for the special order is the incremental cost of the order. So it means how much it costs you to manufacture product for that special order is your minimum acceptable price. You can accept the order if we can hit at least break-even point from this special order. If the order replaces normal business operation, which means you don't have enough capacity to meet the full requirement of the special order, and you have to give up your normal business operation to meet this special order, then you need to think about the opportunity cost. The opportunity cost is the benefit that you will forego from the normal business operation. Therefore, the price should be at least or above the usual price or the normal selling price of your product. Let's have a look at the example. A travel agency has offered Kangaroo Airlines $150,000 to charter a round-trip flight between Korea and Melbourne. The airline does not usually fly this route, so a special analysis is required. The variable costs of the flight are flight crew, cabin crew, check-in crew, fuel, meals, airport landing charges, taxes, maintenance costs, and contingency, and they total $90,000. The fixed costs include allocated portion of the leasing costs, corporate office costs, etc., totaling $100,000. The ticketing costs included in the variable cost of the flight, amounting to $5,000, will be borne by the charter company, which means if you accept the special order, then you don't need to incur $5,000 because you can avoid the ticketing cost. If Kangaroo Airline has a plane which will be otherwise sitting on the ground in Melbourne at the time these flights are made, should Kangaroo accept the charter? So this first question, this is the case if you have spare capacity because you have an airplane that is not being used, okay? The next question, if Kangaroo Airlines will have to cancel a profitable flight, in bracket normal profit $80,000 to Shanghai to fly to Korea, should it accept the charter? So the second question here, it asks you to consider if you have to give up your normal operation, which is the route to fly to Shanghai, to meet the special order requirement. Now let's have a look. The first situation, if we have spare capacity or excess capacity, incremental revenue that we will receive from special order is $150,000. Incremental costs include variable cost $90,000 minus savings on ticketing cost $5,000. So the incremental cost is $85,000. 150,000 minus 85,000 is equal to 65,000. So 65,000 is net profit that you will receive from special order. So in the case of spare capacity, it is advisable for the company to accept the special order. Now let's have a look at the case if we do not have a spare capacity. In the case of no excess capacity, incremental revenue is still going to be the same. 150,000 incremental costs will be 85,000, so 65,000 as before. However, we need to also consider opportunity costs because you're going to be missing out 80,000 profit from your normal business operation. 65,000 minus opportunity cost 80,000 equal to minus 50,000, which means if you have no excess capacity, there will be a loss of $15,000 if you accept the special order. So that's the example of special order under two different situations. You have excess capacity and no excess capacity. Now let's move on to exercise 13.16 from your textbook. It is a case on special order with no spare capacity. Crystal Lattice produces exercise mats for use in fitness centers. Production capacity is 20,000 mats per year. Due to a change of fitness centers closing, Crystal Lattice now has spare capacity of 2,000 mats per year. An international hotel chain, Rest Easy, has recently contacted Crystal Lattice to place a one-off order for 3,000 mats. The hotel chain has recently remodeled a number of its hotels to incorporate fitness centers for guests. So let's stop for a little while here. Production capacity is 20,000 mats. Now, the second sentence tells us that they have spare capacity 2,000 mats. The requirement for special order is 3,000 mats. So 2,000 spare, they need to produce 3,000 mats. It means they have to give up 1,000 mats that they usually sell to their current customers in order to fulfill the special order if they want to accept the special order. So let's continue reading this information. Budgeted costs for 20,000 mats are variable manufacturing cost 800,000, fixed manufacturing cost 900,000. Mats normally sell for $100 each, and Rest Easy has offered to pay $90 per mat. Rest Easy has also requested that each mat be embossed with its company logo. An embossing machine costing 20,000 will therefore need to be purchased by Crystal Lattice. The machine could not be used for other products. First requirement is from a financial perspective, should Crystal Lattice accept the special order? So calculation. Now, if we look at the information from the question, we have production capacity 20,000 mats per year. Idle capacity or spare capacity 2,000 mats. Special order for 3,000 mats from Rest Easy hotel chains. Variable manufacturing cost in total of 800,000 divided by 20,000 mats per year equal to $40 per mat. Contribution margin, if we focus on how much we will get per unit from normal sales, normal business operation, sale price is $100 per unit, variable cost $40 per unit. Therefore, contribution margin from selling one unit to your regular customer is equal to $60. Contribution margin from special order, selling price from the special for the sale for sales price for the special order is $90. Variable cost still the same, $40. Contribution margin then 90 minus 40 equal to $50 per unit. Benefit of special order, a total of 3,000 units times $50 contribution margin per unit equal to a total of $150,000 minus incremental fixed cost, that is the cost to buy a machine, 20,000 equal to 130,000 up to this point. Then we have to also take into consideration how much profit that we will be missing out from 1,000 units of mat that you usually sell to your regular customer. So 1,000 unit times $60 equal to 60,000. 130,000 minus 60,000 opportunity cost equal to $70,000. So this is the net benefit of special order. According to this quantitative analysis, it is still good for the company to accept the special order. However, for us to have a better review about this option, we also need to consider qualitative factors. So that is the requirement part B. What other factors should be considered before the order is accepted? Qualitative factors that we need to consider here is the first one, the impact on our existing customer, our regular one. What will be the reaction of regular customer? Other customer might demand lower prices too. That will cause the company, Crystal Lattice, to get into a pricing war with itself. Will the regular customer approach other suppliers to get their product as we are not providing them enough product anymore? So that could be another possibility to consider. Another qualitative factors that should be included in this analysis is whether you can explore um, the potential of locking a contract with Rest Easy to be a long-term customers that will pay a normal sales price, so they can become a regular customer as well. So that's another option that you need to consider. So that's the end of the first type of tactical decision making. So let's move on the second type of non-routine operational decision making. Make or buy decision, or in-source or outsource decision. Insourcing is the practice of providing the good or service from internal resources, which means you use your own resources to produce a product or to provide service, either to customer or the services or product that you need in your business operation. So you're making it in-house. Outsourcing means finding outside vendors to supply products and services. It has become an increasingly common practice nowadays. So, for instance, many businesses outsource their customer call service to another company, either in the same country or overseas. Another example will be many retailers in the era of online shopping nowadays. Many retailers outsource the distribution part of the operation. So they use Australia Post or Star Trek service to deliver their products to customer, or Uber Eats, okay, instead of having their own distribution department. Some managers go with outsourcing alternative, usually for any activity that they view as unrelated to the entity's core competency. The general rules for make or buy decision, well, it's kind of like a basic cost benefit analysis. You usually go with the option with the lowest relevant cost. Existing fixed costs are relevant only if they can be avoided through outsourcing. Note that for insourcing, you need to identify whether there is opportunity cost that needs to be included in your calculation. So let's have a look at an example here. Kangaroo Airlines currently prepares all meals in-house. A Melbourne bakery has offered to sell kangaroo ready-made dessert at a cost of 21 cents each for 1 million desserts per year. The chief accountant has calculated the following cost for the in-house desserts. Variable cost, 3 items, direct material 0.06, direct labor 0.04, power 0.04. Fixed cost, 2 items, supervisory salary 0.04, depreciation 0.07. Of the supervisory salaries, 10,000 could be avoided if the desserts were purchased, as fewer staff would need to be supervised. Should Kangaroo Airlines accept the bakery's offers? Well, let's have a look at what we have here. So what are the options for you? The option is either you keep making it or buy it from a Melbourne bakery. If you want to buy from a Melbourne bakery, the total cost for you will be 21 cents for each dessert times 1 million desserts per year. It equals to $210,000. Variable cost, if you gonna keep making it, the first type is direct material, equal to 60,000 in total for 1 million dessert. Labor will cost you in total 40,000, power $40,000. 10,000 fixed cost, supervisory salary, it is avoidable if the desserts were purchased from a Melbourne bakery. However, the 10,000 reduction in supervisory salaries, it will not reduce the purchase price of the dessert. Therefore, it will be an additional cost if you keep making the dessert in-house. Okay, so 10,000 should be placed as an extra cost for alternative to make the dessert in-house. So the total cost for keep making it will be equal to 150,000. If you're gonna purchase the dessert from a Melbourne bakery, the price for you in total is $210,000. At this point in time, so a better alternative for you is to keep making your dessert in-house. The second situation is Kangaroo Airlines has a reputation for excellence in its catering. If Kangaroo Airlines accept the bakery's offer, it would free up capacity to produce extra main meals at an estimated cost of $25,000, which could be sold to other airlines for $90,000. So from the spare capacity, how much profit that we will get? So 90,000 minus 25,000 equal to 65,000. Now, should Kangaroo Airlines accept the bakery's offer? With this information, the calculation will still be the same as the previous one at the start, but then we need to consider profits from producing extra milk. So 65,000 extra profit, it will arise when Kangaroo Airline chooses to buy dessert from a Melbourne bakery. Again, this profit will not reduce the total purchase that they have to pay to Melbourne bakery. Kangaroo Airlines will forego this $65,000 profit if it will decide to keep making it instead of buying it from a Melbourne bakery. Therefore, this foregone benefit, 65,000, is an opportunity cost that should be considered as an extra cost if the firm wants to make dessert. Now, the total cost for them to keep making the dessert in-house will be 215,000. The cost for them to purchase from a Melbourne bakery is 210,000. So it is $5,000 saving if they decide to buy dessert from a Melbourne bakery. Now let's have a look at the exercise from your textbook. Your clique currently manufactures a sub-assembly for its main product. The cost per unit are as follows: direct materials $4, direct labor $30, variable overhead $15, fixed overhead $25, total $74 per unit of sub-assembly. Regina has contacted your clique with an offer to sell it 5,000 sub-assemblies for $55 each. Okay, the first requirement, part A. Should your clique make or buy these sub-assemblies? Create a schedule that shows the total quantitative differences between the two alternatives. Note that fixed overhead costs, let me move back to the previous slide. You have the cost structure: direct materials, direct labor, variable overhead, and fixed overhead. So that makes up the total cost for 1 unit of product. Fixed overhead here, the $25 fixed overhead is irrelevant. Why fixed cost is relevant in this case? Because it will still be incurred regardless your clique make or buy the sub-assembly. Therefore, the relevant information for this problem includes the variable cost to make and the purchase price to buy. Cost to make, only the variable cost, $4 plus 30 plus 15 equal to $49. Cost to buy for the company is $55 per unit. Therefore, saving is decision is to make $6. Based on this information, your click will be better off by keep making the sub-assemblies. Now, the second requirement, the accountant decided to investigate the fixed cost to see whether any incremental changes would occur if the sub-assembly were no longer manufactured. The accountant believes that your click will eliminate 50,000 of fixed overhead if it accepts the proposal. Does this new information change the decision? Show your calculation. Alrighty, so what does this information mean for us? If the company was to buy the sub-assemblies, they can avoid 50,000 of fixed overhead costs. So 50,000 fixed overhead costs is avoidable fixed cost if they choose to buy the sub-assemblies. Therefore, it will be an extra cost for them if they decide to keep making it, because that's the benefit that they will forego if they decide to make instead of buying it. Yes, this new information will change the decision. How? Because the cost to make is now increased by the amount of fixed cost that will be eliminated or avoided if the part is purchased, which is $10 equal to 50,000 in total divided by 5,000 per unit. Now the cost to make will be 4 plus 30 plus 15 plus an extra $10 avoidable fixed cost. That in total will be equal to $59. Cost to buy is still the same, $55. Therefore, the saving for the company if they decide to buy is $4. Now that was the quantitative analysis. The third one, Part C requirement. What qualitative factors are important for accountants and managers to consider for your click makes or buy decision? Two qualitative factors will be very important for your click. Okay, the first one is the timelines of delivery. It is an important aspect to consider. Can these potential suppliers, Regina in this case study, guarantee that the sub-assembly will be delivered in time as per agreement? The second one will be the quality itself. It is also important to ensure that the quality of the sub-assembly produced by Regina is not less than the current standard of quality set by your click.